U.S. President Trump has terminated trade talks with Canada. Let's get some perspective on what that could mean for the markets with Philip Petursson, Chief Investment Strategist at IG Wealth Management. Phil, thanks as always for joining us. Thought it was going to be a nice quiet Friday. Not much going on. Then Donald Trump gets on social media and cancels, says the talks are off again. Thoughts on it?
Well, he must be a Dodgers fan. Well, no, sorry. Seriously, I think, I think this is anything that they can do to extract leverage against the negotiations that are coming up between the United States and Canada. From the market perspective, though, we have to take a step back and say, what has changed? And really nothing has changed. We remain in the status quo. We remain in this limbo of tariffs. And so as long as it's not getting worse, then it really wouldn't have an impact on the direction of the Canadian economy other than where we were already headed, and certainly doesn't have an impact on the market.
And with the comments and leverage, does it feel like there's any leverage anymore with what he says?
It doesn't seem like there is. He's getting pressure internally from Republican governors that are being impacted by the tariffs, and there's some senators as well that feel the same way. We've adjusted. Companies that I talk to are finding ways to adjust to the tariffs, whether they're cutting costs or changing the way they invoice. So to invoice, put the minimal amount of the invoice on the tariffable amount of the export. So we figured out ways to mitigate some of those tariffs. And we know at some point down the road that these tariffs will be at a different number, most likely a lower number. So that's where we stand today.
Has he found obviously with the steel and aluminum, those tariffs are out of line, but the other ones, has he found a magic number for some of them that people are willing to accept?
Well, we look at the deals that have been made elsewhere around the world. So we expect that the deal coming for Canada or coming from other countries that haven't yet struck a deal is going to be a permanent tariff somewhere between 10 and 20%. Now, what does that mean? We don't pay for that tariff necessarily. It's the importer that pays for the tariff. And if you look at companies like Walmart, what they're saying is we're going to pass that tariff right on to the consumer. The number that I've been seeing is about 70% of the tariffs are being passed on to the end consumer. And I think that's the way it's going to continue. So this has become a stealth consumption tax in the U.S.
Okay. And then today's CPI came out pretty much on target.
Yeah, in line with what we expected, in line with where we see inflation headed over the course of the next 6 to 9 months. We model it out and we can see inflation. This is probably the top end of inflation. We might get a little bit higher, like 0.1, 0.2% towards the end of the year as the full impact of the tariffs start to be priced in. But then it's going to start to moderate into 2026. I don't know if we'll get to the Fed's target of 2%. Our modeling shows somewhere between 2.5% and 3%, but I think that is tolerable for the Fed. Remember, the 2% target was somewhat arbitrary, came up in 2012, didn't really exist explicitly before that. So, I think reality will set in that historically inflation in the United States has trended closer to 3, then closer to 2.
Okay, and so people are used to it, can handle it?
Especially when the U.S. economy is growing at 3% real, and that's what we're seeing right now. So, if you look at nominal is closer to 6, real is 3. If you have real growth at 3% and inflation at 3%, that's a decent economic environment.
Okay, let's move on a little bit. It's been earnings. The markets seem to be going gangbusters. Looking today, another big day. Are we hitting that point where it's hard to find any deals? Or still room to find some deals, find some bargains?
Yeah, that's a great question. And because we're getting the question as well, saying, is the market too high? Are things too expensive? And well, not in the context of earnings growth that we see going forward. So I worked with a gentleman years ago who said sometimes it's okay to pay 100 cents on the dollar if the company is growing at an above average rate. And that's what we're seeing right now. So it's not necessarily, you have to find the bargains in the marketplace that undervalued assets are there and I'm going to capitalize on that. Sometimes it's, hey, we have great companies here that, yes, you're paying full price for, but they're delivering excellent earnings growth and are projected to do that for the next year at least, if not number of years.
And is that the tech stocks?
That would be largely the tech stocks. And some of these, relatively speaking, they're not that expensive. They're certainly not where we saw in 2000, which is the comparable that we're hearing about today. We're not in the environment of 2000. This is a different environment where these companies that, yes, you're paying up for, but they're generating real earnings, have strong cash flow, and are reinvesting, as we've seen, as your prior guest said, in this AI infrastructure boom. But it will deliver productivity, it'll deliver greater economies of scale, it'll deliver enhancements that will result in real earnings growth for the foreseeable future.
And where does gold fit in? I mean, we saw it dip this week. It kind of has calmed down a little, but it's still on a little bit of a downward trend right now.
Exactly.
Is it going to stay going down a little bit and hover around 4,000, or will it start climbing again today?
I think we can
and
see
what do you do with it?
Right. So I think you continue to hold it in a measurable weight within a portfolio. And so we don't want to be rushing into gold right now. Look, it has had a great run year to date over the last year. Even with the I would say, brief pullback that we've seen, it only takes us back to Thanksgiving, I think.
Yeah,
so,
I mean, that's the thing. It's still up 50, 52%.
It's up over 50%
like that,
year to date, exactly. So, and 60% from where we were exactly a year ago. So I think it's still attractive, but is it going to 6,000 over the course of the next couple of weeks? Probably not. I think it can hover here. If you look at the chart, you can see that gold consolidates. We get a period of consolidation that we saw through the summertime before it has another leg up. So could we see consolidation here before we see a leg up? Yes. But more importantly, what is the fair value of gold? Where we are above what we would call the fair value, but we're at the top end of that fair value range. So we wouldn't get too greedy at this point in time.
Okay. Phil, thanks as always for joining us. Have a
Thank
great
you.
weekend. That was Philip Petursson, Chief Investment Strategist at IG Wealth Management.